What's up, YouTube fam? In this video, we're gonna do A to Z option selling course, or better yet, a mini course, right? To keep it super simple. I'm not gonna look to bore you guys with hours worth of material and talk about tons of things. I just want to keep it, basics, right? Keep it very simple so you guys can understand how to be on your way and start selling options today. So, first things first, right? You just need to decide basically which direction you're going to be heading, right? Which stocks you want to be selling options on, which indexes. Now, this is really something you should kind of have an idea of beforehand, right? Because at the end of the day, option selling is kind of just a variation of investing, right? So, obviously, I have a large list. Majority of these stocks I haven't even touched on this list. Now, when we go to TradingView, I have a little bit of a smaller list. Now, again, I still haven't touched majority of these, but just to basically explain, so TQQQ is the NASDAQ, right? That's like the first thing you should be looking at is the NASDAQ, the S&P 500, basically just seeing where the market is headed, right? So obviously, based on this chart, to sit here and act like I can even necessarily predict it, it's very obviously difficult, right? If people were able to predict where the market was always heading, right, there'd be a lot of very, very wealthy people. But the reality is, majority of people can't even beat the lowest returns of 10%, 20% a year. Now, obviously, if you're someone who's interested in selling options, it's because you want to be beating that, right? Otherwise, you could just buy and hold the S&P 500. So if you're looking to beat 20, 30, 40, 50% a year, 60% a year consistently, right? I think that's a very reasonable target for option selling is 50 to 100%. Obviously, in really rare cases, even more. But with that being said, the first things you should be looking at are the actual stock market itself, right? So TQQQ, TNA, I have SPXL. Now, you might notice every single one I'm looking at is a 3x leverage. Now, this will be the first part of the strategy is just explain to you guys like these 2x, 3x leverage versions of these indexes, they are very risky. But in my opinion, this is one of the best ways to get crazy, volatility, crazy premiums while not having to worry about if the stock you're touching is going to go to zero. So with that being said, the first ducks in a row I would get would be having, indexes, basically just in the forefront, right? Because if you want to start looking at individual stocks, it's most important to know which way the market is heading, right? If the market is completely free falling, then you probably don't want to be buying anything, right? And if you do want to buy something, you want to look at which stocks might be not free falling, right? Like if TQQQ here, obviously you guys can see yesterday, Friday was a pretty bearish day, right? It took a big fall, market closed. Now it looks like it might head down. When we go and look at individual stocks now, if we're going to buy something, something like DocuSign looks good. Something like Amazon looks good. Affirm, maybe not as much, right? So it's very simple in the sense of like, we're just looking at the market as a whole first, and then we're looking at individual stocks to see how they compare to it. Something like Facebook was ripping up while the NASDAQ was falling. To me, that's a great sign. Netflix, made a huge move during earnings, right? Obviously came back. Now it looks like it could head back up. So, again, I'm not looking for you guys to overcomplicate it. This is not a course for technical analysis, right? It's just the simplest stuff. Tesla has earnings next week, but to be honest, this, in my opinion, doesn't look the greatest because, we made the high, made a low, looked like we're trying, and now it looks like we're heading back down. Earnings will be very interesting, right? Earnings is either going to send it down or send it up or, keep it where it is and just kill everyone who buys options. But that's why we don't like to buy options during earnings. We like to sell options during earnings. So the first part of the strategy is just having an understanding of where the market might be heading. Now, again, this is not me saying you have to be perfect, right? It's more about drawing out the scenario. So I'll give you guys a scenario I drew out on the NASDAQ, right, is we have this supply. Now, what I'd like to see is I'd like to see us break through, come back, and head up. But the reality is with supplies is this is more likely, right? Why is it more likely? Because it's all about which side of the zone you're on. Now, again, not to reiterate, this isn't a technical analysis course, but supply and demand is something every trader should have in their arsenal. And ultimately, it's really just taking like the zone from where, the move started. So you can call this a supply zone, or sorry, this a demand zone, this a demand zone, this a supply zone. Again, I'm not looking to overcomplicate it or confuse it. I just want you guys to have a general understanding of the things the market might do, so you can use that to make the most informed choices. Now, with everything being said, with everything I've already said in this video, a lot of it could be very much irrelevant, right? Because option selling is all about time in the market, not time in the market. So what do I mean by that? Well, if we look up TQQQ, right, and we look at, let's just say we start with selling puts, right? Because I always believe if you're going to sell options, you should start with selling puts. Very rarely do I think you should just buy shares and jump into covered calls. And the reason being is, again, when we look at a chart like this, right, in case the market does actually reject off the zone and fall, you're going to be a lot happier that you sold puts. Why? Because so what we want to do is we want to sell puts that have, roughly a 30 delta, right? Or in the 30 to 40 delta. It depends on which stock you're doing, right? Something like the NASDAQ, I think we can go higher delta. So I would be fine with something like this, right? A 30 to 40, maybe high 30s. So if you are, putting up for collateral 8,500, you're going to collect 172. Now, here's where it gets interesting, is your break-even price would be 83.28. So basically, when we pull up the TQQ chart, you see how it's at 86.75. Now your entry is going to become 83.28. So that's the beautiful part about selling puts first, is instead of your entry being 86.75, your entry would be 83.78, which is all the way down here. Now, assuming it never comes down here, which is within the next 6 days, you will just collect the 172 for every 8,000. So with my account size, maybe we could do 2, and we're collecting 344 a week. Now, assuming it does go up, what makes this even cooler is that this will become worthless because, remember, you're selling a put. So when you sell a put, you're basically just betting against puts. So it's not that you're betting on the market to go up or down. You're betting against this specific put. Now, selling calls is the same thing, but the opposite, right? So with selling calls, you would want to go this way out of the money. Now, ultimately, remember, you would need the shares first. So let's just remove this, sorry. So if we were to sell calls, right, the first thing we'd have to do is we'd have to buy the shares at 86.28, and then we would want to pick something out of the money. Ultimately, we would collect 424, assuming, right, it doesn't go above 87.50. Now, if it does go above 87.50, right, which is right here, which of course is not that far, right? So that's the only thing about selling calls is, you get in. Let's see, where's the line? Let's just bring the line down here. So hold on. Okay, so basically, as you see, hypothetically, the way it would work is if you were to buy the shares right now and you would sell at 87.50, let's just say the market does this, and by the end of next Friday, it ends right here at the end of this line. Basically, you would have now bought for 86.28. You would collect 424 for your 200 shares, and then you would also collect $200 because you're getting the difference of 86.30 to 87.50. So, yes, right, you can say that if you were to sell calls and everything went perfect, you would actually make more than if you were to sell puts. Now, the problem is, right, is as traders, we understand that not everything will be perfect. Yes, there will be plays where everything works out perfect, right? For freaking, for Pete's sake, you could just end up buying calls, right? Instead of selling calls, if you really were so confident about your plays, right, then obviously something like buying options will be the most profitable. But the reality is that for the average person, right, the market just does not do exactly what you expect it to do when you snap a finger. And that's what we're prepared for, right? We're prepared for the market to bend us over backwards and sideways. And ultimately, we want to be able to profit regardless. So that's why we sell puts first, because yes, if you just buy shares and sell calls, there's a lot of worlds where you're more profitable, right? And that's the thing about the market, right, guys, is there's a lot of worlds where doing something simpler or different might have made more money than your strategy. But what you'll learn after years of being involved in trading, investing, saving, it's about profiting, but it's also about peace of mind. And if you've been following the channel, you'll know that I've made some very critical mistakes, and why this account is at 21 instead of 30 is because I've taken trades that removed my peace of mind. The moment your peace of mind is gone, your account is, very, very close to being gone as well. So what you want to do is you want to keep everything on the right side of peace of mind. So the first step, in my opinion, is to open up by selling puts, right? The beautiful part, again, is you're collecting premium if it goes up. And as long as it stays above the strike by the expiration, you will collect your premium. And if it goes below, then your break even is going to be much lower than had you just bought the shares or sold calls. Now, where it gets even cooler is, let's say we sell puts for the 85, 172, right? And let's just say, by expiration, it's below, right? Let's say by expiration, it's at 84. What we can do is we can roll our puts lower. And this is where I like TQQQ, is because for you to roll lower, right, at the highest level, you need the option, right, that you're rolling into to be more expensive than the one you're in currently. So you see how this one's worth $1.72. Now, again, these prices will change, so I don't want you to take it literal, but use this example as just a way for you to learn, okay? So you see how it's at the $85 strike is at a 172 premium. So let's say by Friday it's at 84, right? Now, you might want to just buy the shares at 85. You might be okay with that. But let's say you don't want to and you want to roll lower so you can have an even lower cost basis. So think about it like this. As long as the premium is higher than our current premium, we can roll and collect a credit. So you can technically roll as low as you want, but if the premium is lower, then you will pay a debit. But if it's higher, you'll collect a credit. So honestly, it'll be easier for me to explain this with the play I'm already in. So let's look at SoFi right now. So you see how we can click roll this position. So we're already in this play, and we don't have any need to roll it at the moment. All right, our strike is 1650. Our break even is 1594. But let's just say things don't go our way this week, and we say, you know what, we want to roll our position. So notice how our 1650 is worth 49 cents. So as long as the strike that we're rolling into is worth more, then we will be able to roll for a credit. Now, obviously, in this case, we couldn't roll for a credit going for February 7th. And the reason being why this is a little different is because of earnings, right? Earnings makes the premiums jack up. So that's why rolling further, it's actually a lot harder to roll during earnings. But here in this case, right, if we go 20 days out, we can roll into the 16. So you see how we'll collect a $24 credit. That's for that's for our position. So why is this important? Why is it important to collect a credit instead of pay a debit? Is because when you pay the debit, you're losing. When you get the credit, you're actually gaining on top of the current premium. So in this case, this position would make us 56 times 3, 160. Now it's making us 184, where if it's a debit, you're actually losing premium. So it's not the end of the world to pay a debit, but in my opinion, when you roll and collect a credit, it's the best of all worlds because now you're lowering your entry, right? Right now my break even is 1594. If I rolled into this 16, let's see, will it show what the break even becomes? Oh, there you go, 1555. So instead of our entry and break even being 1594, now we're getting 1555. And this isn't even the right one, is it? Here, so let's go here, right here. So now it's becoming 1543. So again, the point is you're allowing your entry to get lower and lower without having to add more money, right? So in the world of investing, if you were to buy, let's just say SoFi at 17.95 and it went to 14, what would you do if you wanted to lower your entry? You would have to buy more, right? That would be called dollar cost averaging. When it comes to selling puts, you have the ability to roll down, and the reason why is because you're buying time, right? So notice how you're going to a further expiration. So it's like a loan, right? It's like extending a loan. That's why it works this way. So you're able to buy time and in exchange get a lower entry. So ultimately, the strategy is very simple. It's to sell puts until you get assigned. So that's the other thing, right? You don't need to roll. You can get assigned, which again would cause you to buy the shares. So with this SoFi position, right, 1650. If it's below 1650 by Friday, I will have to own the shares or roll. So again, this is where we're at. Now I drew everything out for you guys. 1650 is my strike, and the bottom of the zone is the break even. So basically, as long as it's above this strike, I collect the premium. If it's above this, then I'm still in the profit. So if it expires anywhere here, then I'll still be profitable, and I can close, maybe not for the full premium, but at least something. And of course, if I want, I can just hold and take my shares at 1650. So selling puts allows you to have an optimal entry while collecting premium. I like to describe it, it's almost like setting a limit order, but you're getting passive income while waiting for the limit to hit. So there's a lot of cool sides to it. But with all that being said, ultimately, I think where people go wrong is, one, they're buying the wrong stocks. 2, they're going straight into covered calls on the wrong stocks. 3, don't even get me started with poor man's covered calls, right? I don't believe in it. I don't think anyone should really be doing it. To me, it just doesn't make sense. And ultimately, I think what you should be doing is figuring out stocks that you are 100% interested in investing in, selling puts, and then if it goes down, you either roll lower so you can keep lowering your cost entry, or you just get assigned and ride it back up. Now, Connell is another great position. I'm not going to talk about this position much more, but what's crazy is, I'm not going to mention the break-even price because I rolled this, so it's a little skewed. But the important thing to consider is if it expires below 45, I will be buying at 45. Now, I might roll it one more month if need be, right? I would consider rolling it even further. I don't plan on it, but let's just say by February, crypto markets completely collapsed. I would consider rolling it lower. But what's important is when I got in this position, Connell was at $60. Now I'm in a position where as long as it's below 45, I'd buy at 45. So instead of buying at 60, I'd be buying at 45. These are the things about selling options that make it so fascinating, because you can keep rolling your cost basis lower. So if you truly believe in the stock, right? If you truly believe in the stock you're selling options on, then basically it dumping is in a lot of ways the best thing that could happen, because you're in a position where you can keep collecting premium, keep lowering your entry, eventually get assigned, right? And then ride it back up. So, the mistakes I've made involved not truly believing in the stocks I was playing, and it led to me making panic selling, just bad mistakes in general. But as long as you truly believe in what you're getting involved in, then it falling in a lot of ways is the best thing that can happen. Now, another mistake I've made with Connell was the fact that it only had monthly expirations, right? You want to be looking for things that are having enough volume to support weeklies, right? Another good example would be FBL. Like, this is a stock I'd love to play, right? Because it's Facebook times by 2, which to me, it's like, who the heck wouldn't want that? But look at these options, right? So it's very important before, selling options to consider just basically what the volume is, what the open interest is, and ultimately how many options there are there weeklies, etc. So, there's a lot we can talk about. Obviously, there's infinite stocks, and you can apply these strategies to anything, right? That's the first step, is picking a stock you're truly interested in investing in. Rumble's a good one, right? Let's just say I really wanted to get Rumble, which so part of me does, part of me doesn't, right? And so first things first, they have weekly expirations. That's amazing. Let's see if we were to look at, February 7th. I would want to go a little lower on the delta for this, right, than I was TQQQ, so 25. So I guess one of these would be, the lowest, or sorry, I wouldn't go any of these above this. So basically, hypothetically, we want to sell puts, right? Let's say 10. Boom. So for 12,000 or 13,000, we're collecting 500 in premium. Now, the max loss, don't let it scare you, because again, that's just if the stock goes to zero, because of the fact that you're going to be held liable to buy 1,000 shares of this position. So in a lot of ways, again, best thing that could happen is it falls, you collect your premium, you get a good entry, stock goes back up, boom, you're making more money than you've ever made before. So listen, guys, is selling options going to be the most profitable strategy on the planet Earth? No, right? Is it going to be, let me turn $100 into $1 million like some of these guys are saying? No. But it's going to allow you to accept the fact that you can't predict where the market's going. You don't really know, right? Maybe you have an idea. And that's the beautiful part, right? A lot of forms of trading, you have an idea of where the market's going, you lose money, you get pissed, you get emotional, you lose more money. And with option selling, it's like you have an idea of where the market's going, you're wrong. You have time. You can think about it. Do I roll? Do I close the position? Do I wait? Do I get a sign? Do I just let it rock? Do I play the wheel strategy? And that time just allows you to turn even the biggest mistakes into wins. And that's why, I've been able to scale this account fast, right? But then when I started to make huge mistakes, at first, yes, this looked very scary, but now it's started to even out, right? And instead of panicking, and I have panicked. That's the funny part, is I've had moments where I've panicked. And, obviously when it was this low, it wasn't easy. It was gut wrenching. And if I didn't panic, yeah, I'd be at 27, 28K instead I'm at 21. But that's the beautiful part, right? I could have started this account and turned 20K into zero if I was buying options, which I've done before in my life of trading. I've turned $10,000, $20,000 accounts into zero. And if you're watching this, maybe not 10, 20K, but I'm sure you've turned some sort of accounts into zero before in your life. With option selling, there's really no reason for that to ever happen. You know, like truthfully, I flirted with death with some of the positions I've taken on this channel and in this challenge. I've done it live. You know, I've had no shame. But as long as you're sticking to stocks you truly believe in, or even better, things like TQQQ, like indexes, there's really no world where you're going to turn your money into zero. You know, maybe your account will take some hits in the short term, but long term, you're pretty much always going to make money. Now, it's a good problem to have, right? Because I think with option selling, you know, there's a much better chance that you make money and then you say, oh, I could have done this and made more than lose money. And that's the most important thing. The most important thing is how much did you deposit from your bank account and how much did you withdraw into your bank account. Everything else is kind of like noise, right? If you go to the casino and you sit down at the blackjack table with $100 and you swing from $20 back to 80, back to 10, back to 90, back to 40, back to 200, and then you finally get up with, let's just say 250, you made 150. Everything in between was irrelevant, right? So, you know, option selling, I think, allows you to really think more clearly, allows you to buy yourself time, and allows you to prevent panicking as long as you're doing it on the right stock. So I hope you guys learned a lot. You know, I'm sure some of you might be saying, oh, this is it. How is this a course? Well, guys, keep in mind, it's literally just clicking a button, right? Like if you want to sell an option, obviously right now is a Saturday. The market's not open. But let's just say Monday morning, you want to sell SoFi options. You know, you click view sell options, you click sell put, you know, you click a button, right? So I don't need to give you guys a 6-hour course. There's a lot of other things we can talk about, right? I have the earnings chart open. So obviously with earnings coming around, premiums are going to be a lot higher. Obviously there's going to be a lot more volatility. And that's the thing about options, right? Is volatility creates higher premiums. That's the trade-off. And that's something that has caused me to lose a lot and make a lot, right? Is I got blinded by volatility and high premiums, which allowed me to put myself in a lot of risk. That's why we like earnings season, because we can buy or sell options on stocks like Tesla, Microsoft, Facebook, and still have very high premiums as opposed to most of the time when the premiums are low. So with all that being said, again, I don't want to overcomplicate it. I've been making videos on this channel for months now, basically a video a day. So if you want to really learn, you know, there's two things to do. One, you could watch my videos every day, right? Just so you can learn along with me. And two, you can go ahead and do it yourself. Now, obviously this isn't a game that poor people should be playing. Now, not even that poor people should be playing. It's impossible to play unless you have the money. Now listen, there's obviously other option strategies, right? Like, you know, we can click on the builder and talk about all these other strategies, but it's just not for me, right? I want to keep it simple. I want to be able to explain it in simplest terms. You know, if you're a young kid and an older adult, you know, tech savvy or not, I want you to be able to understand what I'm talking about. So I hope you guys learned a lot. I hope you feel ready to sell options. If you knew nothing before this video and you still feel confused, don't get too hard on yourself, right? I studied, you know, terminology and option selling for months before I started doing it. I was invested in the markets for years. So, you know, it was like I had a lot of experience with investing and trading, but I still watched option selling videos for probably 3 to 6 months before I finally sold an option. And then once I started, you know, yes, at first I was making money hand over fist very quick, but I finally learned the hard way. And now I think I'm in a great place to just take the lessons I've learned and just scale this account up, you know, the way it should have been from the beginning. So again, if you feel lost still, don't be hard on yourself. It's going to take time. You're going to have to watch a lot more than just this video. But I think this course, or whatever you want to call it, should be a great start for anyone in their option selling journey. So that's all for today. I hope you enjoyed this video. Make sure to give it a like. Make sure to comment your thoughts. If you have questions, please. I respond to every comment individually, personally. So make sure to comment your thoughts. Make sure to subscribe for more content to see where I take this account, and ultimately just learning more about option selling from me, with me, and just in general for yourself. So again, I hope you enjoyed this video, and I will see you in the next one.